What's going on, everybody? It's Jeff here. Welcome back to the channel. All right, guys, we saw a little bit of a relief in the markets, still red as of today. In this video, I want to go over something very important. Had a lot of people reaching out to me asking what I think about starting to buy a long-term position, dollar cost averaging. And I know I've spoke a lot about looking at the volume when it comes to these relief rallies. We're not really seeing buyers step in. It's just that the shorts are taking a breather, letting the stock prices kind of slowly grind up just to capitalize for another leg down. And I've talked about that volume being very important because when you see the volume behind it, then you're going to know buyers stepping in. However, we are still in a position of a relief rally and we haven't hit bottom as of yet. So there lies the big question. What do I look for when I'm trying to find out if we've hit bottom? And there's many key factors that go into this. And I know I focus a lot on the charts, but I want to cover a couple things that are very, very important. First thing being, you're never going to be able to time the bottom perfectly. You're never gonna be able to sell at the top and time the bottom. All right. I look back over the years and I remember in 2008, 2009, when I got crushed, I said to myself, next time this happens, I'll be ready. Well, 2013 and 14 happened. I got a huge crush again. 2018, same thing happened. And there I was after so many years in the market, still very unprepared. We didn't have access to the information like we do as of the last couple of years. However, when March 2020 hit, I could finally say I was prepared. I was not the first person to get out of the market, the first one to sell, and I was definitely not the first one to buy back in. However, two things happened. One, by getting out of the market, seeing that the Chinese economy was completely closing down, it helped me spare some losses to the downside. And then also getting back into understanding what this quantitative easing would do for the markets and all the stimulating the economy, I was able to really ride the market on the entire way up. As you guys know, in August and September, I slowly started to cut my positions, and clearly I didn't sell at the top. So here lies the question of when to get back in. And obviously, there's more to it than just the charts. So in this video, I want to go over a few key things that you need to pay attention to going forward. So let's get right into it. First off, I do want to highlight this. Snapchat, another stock just bombing from all-time highs of 83, giving poor guidance, actually misleading guidance from April that was changed. It was really ironic to see a company, a small to mid-sized company like Snapchat, pulling down the entire tech sector. You know, you used to really only see that from like, your FANG stocks, your NVIDIA, your AMDs, and so forth. Now seeing it from Snap just really puts a good perspective on the type of market that we were in. Even Facebook was down, closed at 7.62%. or 7.62% on the downside. But let's get into exactly what happened today, because there was a couple, good signs and indications going forward. So Fed President Bostic had stated that he believes there should be a pause in September, meaning the Federal Reserve plans to raise the Fed fund 50 basis points in June and July, okay, which is completely priced into the market, if not overpriced into the market. And Bostic had stated that he believes that they should cool this down just a little bit. Now, there is a room for argument that the Fed is completely late when it comes to combating inflation. However, if you just drop the hammer and raise rates, 100 basis points month after month, there's a couple things that are going to happen. You're going to crash the entire economy. You're going to crash the stock market. And therefore, the Fed is the only one left to pick up the pieces, okay? And that's not something that they want to be able to do. However, going too slow is obviously not beneficial either. So they're trying to find that, that soft landing, as they so call it. They might be in a little bit too deep. Here's where the worry lies. And I know some of you might not fully be seeing this, is overcorrection, okay? When the economy falls, when equities fall, when bonds fall, they fall fast and hard, and it always takes a lot of time to be able to recover. Look what happened to the dot-com crash. Look what happened to the crash in 08 and 09. Look what even happened after COVID, and that recovered very quickly, but still within 5 weeks, boom, it's wiped away. Think about the economy, not just the stock market. It took a lot of time, okay, for the economy to recover and get back to a state of normalcy. Yes, there was obviously other restrictions because of COVID and so forth, but still, the point of the matter is that when these things happen, they drop hard and fast and they never recover as quickly. So that is something that the Fed is very concerned about, overcorrection. And it is real because it would put us, I think, in a much worse situation than we're currently in. So this was good news going forward. Second thing I want to talk about, which is very important, is how bonds correlate with treasury yields. The 10-year note is down off that 3% and is slowly fading, which is good for existing bonds, okay, and obviously for the stock market. Now, it's a very known fact that investors will start to flee the stock market in times of uncertainty and move over to the bonds. They're more of a safe haven and so forth. But when does that rotation come back? When does it come to a point where investors and institutions, and I'm talking big money, will sit there and be like, you know what, this stock is a good deal? And looking at the charts and saying it's down 50%, it's down 70%, it's down 90%, that doesn't really matter. That's not what they look for. So here is something you're going to want to keep a close eye on. And I talked about this earlier in the group. I'm going to explain it for you. Dividends play a big role in where investors will find value when the equity markets become to a point to where they are a good buy. Again, we're going to talk about the SPY for very, just a very simple way to understand this. Currently, the dividend right now yields 1.47%. It's $1.37. It's done quarterly, so that sums up to about, I don't know, maybe 560, 570 a year. In rough numbers, they're going to want to see this yield risen, okay? They're wanting to see it higher than that 1.47%. They have them to be more enticed to get back out of bonds, okay, as they see where the treasury yields are and jump over into the equity market. Now, how does that happen? Okay, the SPY is not going to raise the dividend. It's just not going to just, jump it up to that, $2, $3 in order to increase the yield. So the only thing to happen is for the equity prices to drop in very easy to understand numbers. If a stock price is $500, okay, and the dividend is $125 or equal to $5 per year, that is a 1% yield. In order to get a 2% yield, the price needs to fall to $250, keeping that same $5 per year dividend or $1.25. It's the only way for that yield percentage to rise. Obviously, unless they're rising dividends, which they're not going to be doing, especially in times when the markets are pulling back. So once you start to see this yield number start to rise a little bit higher, we've talked about that 380, 385 being very important on the SPY. Beneath that is at 340 and 360. But when you start to see that number become more enticing, and then investors start to say, you know what? The equity market is really undervalued, okay? And it doesn't matter what Tesla's sitting at, what Palantir is sitting at, what, any of your high growth stocks are sitting at, or Nvidia or Apple or whatever. They're going to want to look at those macros inside the market to say, we're going to shift out of bonds and dump it back into the equities. That is a very big thing to look at, okay? Now, obviously, we are fighting a couple different things as of right now. All right, you have inflation that is running rampant. You have jobs everywhere I drive, employees, big companies, small companies, fast food, restaurants, wherever you want to look at, are desperate to hire people, offering very good wages above my state minimum wage and the federal minimum wage. Okay, everybody's looking for work. However, you have record unemployment. All right, and another Fed president said the other day that there's just a surplus of savings still inside household accounts. All right, now eventually, unfortunately, it seems like individuals, okay, are a little bit too late when it comes to, listen, prices are getting higher, the market's going to change, let me slow down spending. And they don't really slow down spending until they look at their credit card and say, you know what, I'm sitting at 80% utilization and I don't even have, a month's worth of my rent payment or my mortgage in my savings account. Let me stop going out to eat. Let me stop buying the useless things. Amazon had already started to cut some of the production in addition to its warehouses, okay, some of its warehouse staffing as well, because they are seeing online sales slowing down. When you start to see this unemployment number rise, which it needs to, it's a very good sign that inflation will start to be coming down just a little bit as households are stopped spending as much money, okay, as well as a key indication of a bottom could be forming. Now, most times, all right, obviously March of 2020 was just a little bit different. We could take a look at this weekly chart on the SPY. March of 2020 was a little bit different, but a lot of times when bottom hits, it's a little bit more rounded than just this massive spike. So don't look at it that you have 1 week, 2 weeks to get in. You're going to be able to have a good eye on, okay, what is the yields at? Where are bonds at? What are treasury yields doing as of right now? You're going to want to start to see those fall just a little bit. All right, where is inflation sitting at? And obviously, where is unemployment sitting at? Now, there's never a perfect time to, like I said, time this perfectly, but those are a couple key things you can look at going forward in order to start to get back into the market. And I've said this before, and I will say it again, we are an exciting time, okay? Because I think back to all the history of what I said in my investing career, next time I'll be ready. This is when generational wealth is created, right? The time to hear about this isn't already in, late 2021 when your barber is talking about the stock market going rampant. He's showing you his, Robinhood portfolio, okay, and saying, yeah, look at this stock that you've never heard of, a company that you didn't even know that does, that's up 40% in 2 days. That's not the time to be getting into the stock market. All right. I know a lot of us are down. So, some of the positions I do have, including AMC, is currently red as of now. However, these are the times to prepare for. So, guys, I'm going to start creating a little bit more content based on this going forward. Try to prepare it as myself and everybody as much as I can. That's it for this one. I'll see you in the next one.